let me give you the good news here. The good news is you don't want to be investing with a robo-advisor right now, because you need somebody smart, looking at your investments and really thinking through the consequences of what's happening in China, what's happening with the global growth situation or lack thereof, and what the indirect implications are for various elements of the portfolio. This China thing is a perfect example of something that's not in anyone's formula. So if you go back and you look at, robo systems that are built on nice little formulas that worked perfectly well in the 80s and 90s, they've got nothing to do with today's environment. And this China thing is a great example. Now, the bad news about China is precisely the same, really, which is that the consequences are rippling through the global economies and the capital markets in ways that are not easy to detect or predict. If you think back about the CMO crisis of 2007. Remember that it was a very well-known fact long before people understood that it was really going to bite the real economy. Most economists, including the Fed, thought that the real economy is going to be just fine even though they saw the CMO crisis unfolding. It takes a long time for the other shoe to drop frequently. A great example, by the way, a different one would be oil prices. Who saw the oil price collapse coming? And then, the consequences for the energy companies and the fact that everybody has to keep producing oil, even though it's diseconomic, driving down the price even further. So the China story is not therefore I'm going to make this particular move because China's in trouble. You really have to think very hard about the indirect ways that a lot of these bets have been placed and what it could mean for your portfolio.